Hi everyone, this video is an introduction to trading supply and demand. So this lesson will cover the following. What is supply and demand? Why should you study supply and demand trading method? How supply and demand zones form in the market, and the benefits of supply and demand trading method. So what is supply and demand? Supply and demand is a trading method designed to identify where banks and financial institutions are likely to enter and exit their positions based on likely areas of supply and demand. So why should you study supply and demand? To start any business, you should know everything about it. Otherwise, you will never succeed in it. The same thing when it comes to trading financial markets. If you have no idea how the market works, you will never figure out a way to make consistent profits. Financial markets are composed of two players, market makers and retail traders. Unfortunately, market makers have more chances to make money in the market. Market makers are commercial banks, central banks, hedge funds, brokers, and big financial institutions. Market makers employ the best technical analysts, price action analysts, mathematicians. They have the best trading tools and algorithms, and they trade millions of dollars every single day. So they have the power to manipulate and control the market. Retail traders are individuals who trade their personal accounts. They have small trading accounts, and they know nothing about how banks and financial institutions trade the market. This is the reason why 95% of retail traders lose money in the market. Let me give you an example just to help you understand why 95% of retail traders lose money in the market. You know, when you are a beginner and you start trading, it is like you are a novice boxer who wants to compete with a professional boxer. A professional boxer always prepares physically and mentally. He's strong and fast, he's experienced and flexible, and if you are a novice boxer with lack of knowledge and experience, you will definitively get knocked out. The same thing happens when trading financial markets. 95% of retail traders are beginners. They have no knowledge and no experience in the market, and they want to compete with market makers. You know, banks and financial institutions know how most retail traders analyze and trade the market. They know about patterns, price action strategies, indicators. They can predict when you likely enter and exit your positions, and they are in the market to take money from you. This is the truth that nobody will tell you about. But the good news is that there is a difference between boxing and trading. In boxing, you can't avoid competing with your opponent. But in trading, you can avoid competing with market makers by studying their trading strategies and following their footprints. So when you open your chart to make your analysis, you should remember that it is not your market. It is the bank's market, and you have no control on it. So your trading success is only possible when you stop trying to fit different rules to market you don't control. Your trading success is only possible when you start studying how the major participants trade the market. And supply and demand trading method will help you identify where banks and financial institutions buy and sell, and all what you have to do is to follow their footprints. Supply and demand is a trading method where the idea is to find points in the market where the price has made a strong advance or decline and mark these areas as supply and demand zones. The point in which the price has made a strong advance is marked by the trader as a demand zone. As you can see here, this is a clear strong move up which indicates a demand zone. A point where the market has made a sharp decline is marked as a supply zone. As you can see in this example, the market made a strong move down, which indicates a clear supply zone. The idea behind supply and demand trading is when the market makes a sharp move up. As you can see here, the large institutions are not able to get their entire trade placed into the market. Therefore, they leave pending orders to buy at the zone with the expectation the market will return to the zone and the rest of their trading positions will be filled. Other financial institutions identify the demand zone and they decide to enter when the market returns to this area. This way, they are sure that they will trade in the direction of other banks and financial institutions, and this is why when the market returns to this zone, we note a very strong move up. The same thing happens when it comes to a supply zone. When the market makes a sharp move down, the bank or the financial institution is not able to get the entire trade placed into the market. Therefore, they leave pending orders to sell at the zone with the expectation the market will return to the zone and the rest of their trading positions will be filled. Other financial institutions will note this strong move down. They identify the supply zone, and when the market returns to the zone, they will enter the market as well. This way, we can see a strong move down when prices approach this area. Your job as a price action trader is to find these zones and place your orders at the same areas where banks and financial institutions trade. And by mastering supply and demand trading method, you will not trade as a retail trader, but as a market maker. Let me give you a real chart example. As you can see here, this is the Euro USA dollars for our chart. The market makes a sharp move down, as you can see here. This move is very strong, and it is made by a bank or a financial institution. Nobody can make this move. It is not made by me or you. This move is made by a bank or financial institution. And as we know, this bank is not able to get the entire trade placed into the market. So it will leave pending orders here. This strong move is a reference point for other banks. When the market returns to test this area, they will enter the market as well. And as a price action trader, your mission is to identify the supply zone. As you can see, when the market returned to test this area, buyers were clearly rejected, and we had a good price action signal that confirmed our entry. Look at another example. As you can see, this is the Euro JPY daily chart. The market made a huge move up. This move is made by a financial institution. When the market returns to test this demand zone, the market will make a strong move up. And that's what happened, as you can see here. This is how banks and financial institutions trade the market. And if you master this trading method, you will be able to predict strong future moves before they even happen. And this strategy will help you find high probability trades with high rewards and low risks. Supply and demand form in different shapes in the market. And in the next lesson, you will learn how to identify different supply and demand patterns in your chart and how to differentiate between strong and weak supply and demand zones.